Welcome back to the Stocks Update. I really appreciate you being here with me today. We've got a lot to talk about, especially if you're interested in the EV electric vehicle space, and more specifically, Lucid Motors. In this video, I'm going to take a deep dive into the recent institutional activities surrounding Lucid. Yes, we're talking about the latest 13F filings that give us an inside look into what big financial players are doing with their Lucid investments. It's always fascinating to see what's going on behind the scenes. But that's not all. There's a lot happening in the broader EV market, and it seems like some serious shifts are underway. Tesla, once the uncontested king of the EV industry, is now facing stronger competition than ever before. Market share is starting to slip, and guess what? That opens up opportunities for companies like Lucid to step up in a big way. All right, let's get right into it. To start things off, let's talk about Tesla. They've got their earnings report coming out after hours on Tuesday, and there's a lot of anticipation in the market about what that report will reveal. Now, if we rewind the clock a bit, say about 6 months ago, whatever Tesla announced, whether it was good, bad, or neutral, it would often cause a ripple effect across the entire EV sector. If Tesla stumbled, other EV stocks usually took a hit too. But interestingly enough, that pattern seems to be changing. Recently, when Tesla has reported negative news or has been hit with challenges, other EV companies haven't necessarily followed them downward. In fact, in several instances, we've seen EV competitors actually gaining momentum when Tesla shows signs of struggle. That's a strong indicator that Wall Street is beginning to separate Tesla from the rest of the pack and is reassessing how it values other EV makers independently. Some of this sentiment comes directly from the latest Q1 numbers out of California. Tesla's grip on the EV market there is slipping, and it's not going unnoticed. We're now seeing data that clearly shows other EV companies gaining ground. In addition to the earnings report, another major headline just dropped. Tesla is reportedly delaying its U.S. production plans for the cheaper Model Y. That's a big deal. Anytime a company delays production of a major product, it raises questions about internal operations, strategy execution, and overall stability. For Tesla, this delay suggests that everything might not be running as smoothly behind the curtain as they'd like investors to believe. And when Tesla falters, guess who stands to gain? That's right, other EV manufacturers like Lucid. This delay in Model Y production essentially creates a window of opportunity for competitors to capture more market share, introduce new models, and establish a stronger presence, especially in the U.S. market. One of the most significant developments for Lucid recently has been its acquisition of Nikola's production facility. This is a game-changing move for the company. Even some of Lucid's critics, analysts who typically lean bearish, have had to acknowledge that this acquisition is a smart play. For example, John Murphy from Bank of America recently commented on the move. While he issued a somewhat bearish rating on Lucid, citing concerns about potential dilution, he also gave credit where it's due, highlighting that the Nikola facility brings real value to the table. This acquisition could accelerate Lucid's production capabilities, potentially pulling forward key manufacturing milestones. There's speculation that Lucid might be able to fast-track its expansion plans, moving goals that were initially set for late 2026 up to an earlier date. In the big picture, this is yet another example of how Tesla's stumbles are opening the door for other EVs to step up and fill the gap. It's a pivotal time for the industry, and Lucid appears to be positioning itself wisely. Now let's shift gears and dive into the data that excites investors the most: the 13F filings. These quarterly reports from institutional investors give us a sneak peek into what the smart money is doing. And in Q1, the data was quite telling. A lot of big-name financial institutions increased their stakes in Lucid. Let's break it down. BlackRock, one of the largest asset managers in the world, increased its Lucid position by approximately 5.38 million shares in Q1. That's a notable bump and signals confidence in Lucid's long-term vision. State Street, another financial heavyweight, also added significantly to their position, around 3.26 million shares. First Trust made similar moves, suggesting a broader institutional belief that Lucid is currently undervalued and worth betting on. Now, here's where things get even more interesting. Vanguard, another top-tier institutional investor, boosted its Lucid holdings to around 26.17 million shares. That kind of investment from a giant like Vanguard isn't made lightly. It reflects a strong conviction that Lucid has solid fundamentals and promising potential. But they weren't alone. UBS increased its holdings to approximately 23.85 million shares. Millennium followed with a hefty 19.42 million shares. These are not small-time players. These are well-established institutions with access to in-depth analysis, predictive models, and massive resources. When they start to make moves in unison, it's usually for a reason. Interestingly, this quarter marked the first time the PIF Public Investment Fund didn't increase its stake in Lucid. But most analysts believe that could simply be a temporary pause, and we might see fresh movement from the PIF in Q2. Time will tell. Despite these promising signs, Lucid hasn't been immune to market manipulation, something that long-time investors have grown frustrated with. Currently, around 23.13% of Lucid's free float is being shorted. That's a massive number, especially when you compare it to 2021. When the short interest was just 7.69%. What's the takeaway here? Well, short interest at these levels typically suggests that there's a concerted effort by some traders to suppress the stock price, possibly to accumulate at lower prices or simply to capitalize on the volatility. But here's the silver lining. When companies with strong fundamentals and long-term potential are being shorted heavily, it can often create a spring effect. Once momentum shifts, the stock can experience sharp upward movement as shorts begin to cover their positions. So, the big question remains: when will Lucid reach profitability? Based on current projections and strategic developments, many analysts believe that Lucid might start seeing profitability by mid to late 2027. That's assuming everything continues on the right trajectory. If there are unexpected challenges or delays, we could be looking at 2028. However, with the Nikola facility acquisition and Tesla's weakening dominance, Lucid may surprise us and hit profitability even sooner than expected. It's still early days, but the path forward is becoming clearer. So now that we've covered all of that: Lucid's strategic acquisition, institutional backing, rising short interest, and Tesla's market challenges, let me turn the question over to you. Are you currently buying the dip? Are you holding steady or thinking of selling? Drop a comment down below and let me know your strategy. Also, what are your thoughts on Tesla? Do you believe they're truly losing market share to other EV players like Lucid, Rivian, and even legacy automakers entering the space? Let's get a conversation going. I love hearing your thoughts and reading through your insights. It really adds value for the whole community. If you found this video helpful, please give it a thumbs up and consider subscribing to the channel. Your support helps us continue to bring you in-depth market analysis. Thanks for watching, and I'll see you in the next video. Take care.